Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. President Trump says he will be substantially raising the tariff on Indian exports to the U.S. over India's purchases of Russian oil. We gauge the impact of trade tensions on the Indian markets and businesses with Rashesh Shah, chairman of Edelweiss, one of India's top diversified finance firms. Asian equities following Wall Street's gains on rate cut hopes and bargain hunting, but some top firms warn the rally may falter as lofty valuations collide with weak economic signals. Veteran market strategist Jim Bianco will be weighing in on the Fed's next move and why he thinks policymakers may be cornered by mixed signals from the economy. And Michael Kretsios, one of the architects behind the Trump-era AI action plan, tells us how the U.S. is ramping up chip tracking tech to scrutinize the flow of semiconductors. President Trump says the U.S. will raise tariffs on Indian exports over the country's purchases of Russian oil. India's foreign ministry calls the move unjustified and unreasonable and says its energy imports are a necessity. For more, let's bring in our government reporter, Sudhi Ranjan Sen in New Delhi. Sudhi, tell us more about India's reaction to Trump's threats. We know that it's been indignant, defiant, having to choose between cheap oil and also those high tariffs.
Well, to begin with, it's a very sharp rebuttal, and it's a very uncharacteristic response from India that we have seen, and especially one way to, compare the statements and that we have seen in the past, in the recent past, because India has kind of held the U.S. relationship and tried to nurture and develop it. There have been suggestions from the establishment about how close the two leaders are, but Trump, there was a lot of emphasis, so to say, on the Trump-Modi relationship, but all that seems to be unraveling, and the response, therefore, yesterday is very, very uncharacteristic. And if one were to compare the statements that came out in the recent past, last week itself, India said that the ties between India and US are very strong. It expected the relationship to grow, and the fact that the relationship had in the past come under stress and strain, but has continued, and there's been no larger issues. From there, yesterday's statement is very uncharacteristic. We can say it's a very angry statement that we are seeing for the first time coming out of New Delhi since President Trump has, taken over, threatened India with tariffs and penalties.
Sudhi, of course, India is not the only country buying cheap Russian oil. Take a listen to what one commentator had to say.
India is pushing back. I expect them to continue pushing back. Also, it's going to be very bad optics for Trump if he imposes the secondary tariffs on India for buying Russian oil and doesn't do so on China, which is a bigger buyer of Russian oil, simply because who knows?
So, Sudhi, what does this mean for the U.S.-India relationship? As you indicated not too long ago, both leaders hugged each other, talking about how great their relationship was.
Well, I mean, India sees diplomacy as a long-term game, and therefore what I can understand by speaking to from speaking to officials out here, the effort and the attempt will still be to continue with the discussions, and that's what we have seen in the trade deal also. I mean, despite the fact that the interim deal couldn't come across, India was very clear that negotiations continue. In fact, as my colleague Shruti Srivastava has been reporting, a team of U.S. negotiators are expected in India in the later half of August. So clearly, India, while these angry statements are flying around, bureaucrats and those who are, actually doing the diplomacy behind closed doors still continue to work. And that perhaps is the silver lining in the entire issue of India-US relationship. Mind you, there is the issue of China's aggressiveness in the region, and therefore the shared interest between India and the US.
Sudhi, thank you so much for that. Bloomberg government reporter Sudhi Ranjan Sen in New Delhi. Now we'll have more analysis out of India later this hour. Edelweiss Group Chairman Rashesh Shah will be joining us exclusively with his views on trade and the Indian markets. Let's get perspective now from market veteran Jim Bianco, founder and president at Chicago-based Bianco Research, which provides data-driven analysis and market commentary. Jim, good to have you with us. We know that tariffs remain front and center, but there seems to be no reaction whatsoever in the markets. I mean, it's not even showing up in the different asset classes.
At least not yet. And I think the reason it hasn't shown up is because it's still hard-pressed to find it in the inflation data, that the end user, the consumer in the United States, is actually paying higher prices for it. Now, that might be coming because there's some evidence that in April and in May and into June, a lot of exporters, China, for instance, Japanese automakers, to give an example, cut their prices initially right after Liberation Day. And that cushioned the final price that U.S. consumers paid. But starting in July and into August and through September, they're expected to raise those prices again back to pre-Liberation Day levels, in which case by the end of the third quarter and into the fourth quarter, we should start seeing some inflation numbers. And if that's what we do see, then we'll start talking about a tariff impact.
But what kind of numbers, what kind of impact? Some are perhaps making comparisons to Nixon's tariff regime in 1971. We're talking about 10% at that time, but that left no impact whatsoever on earnings.
Yeah, at least it will have an impact on the inflation numbers, and it'll have an impact on the earnings of who's ever an importer and the like. Apple did detail some of the inflation tariff costs on their iPhone production, and it is having some kind of an effect on them. And I suspect what you could see is that by the end of the third into the fourth quarter, a lot of the inflation statistics will go over 3%. Now, why is that important? Because after the weak payroll report that we saw last week in the United States, the Fed will be put in an impossible situation. Cut rates because of the weak payroll report. You absolutely cannot cut rates if we have 3% inflation at the same time, and they'll be faced with a bad choice. Whichever choice they pick will be wrong, and then you'll have President Trump hanging over them and threatening to fire Jay Powell if he doesn't do what he wants him to have done.
What choice do you think the Fed will make? What do you see the Fed doing in the coming months?
I think the Fed is leaning towards cutting rates right now. I think that the pressure is building on them because of what we saw in the labor market. I personally think it will be a mistake if they were to cut rates, because I don't think that that's going to solve the ills of the labor market, and I think it will just stoke more inflation in the United States. But I think that we're going to see that. And don't forget that President Trump has said in the coming days he's going to announce a replacement for Fed Governor Kugler, who announced on Friday she's going to resign effective as of this coming Friday. And then if that person is confirmed by the Senate before the September 17th meeting, that adds one more vote towards cutting rates for the Fed. And that might be enough to push them over the edge and see rate cuts as soon as September.
And you have suggested that that might lead to a shadow Fed. How will that be seen by the markets? How do you see the markets responding to that?
Yeah, so the shadow Fed is a term coined by Scott Bessent, the Treasury Secretary, that whoever President Trump announces as the Fed governor to replace Kugler, maybe later this week or into next week, will also be eventually Jay Powell's successor when his term is over in May, unless Trump moves to fire him earlier. And that person will be the Fed chairman in waiting. And the idea is the market will turn their attention to them and what they think was going to happen, because they're going to be the Fed chairman for the next couple of years, marginalizing Jay Powell, making him a lame duck that he's got it'll be like listening to the president of the United States after the election that he lost. Everybody pays attention to the president-elect, will be effectively paying attention to the Federal Reserve Chairman-elect for the same reason.
Jim, in the last few minutes, I can detect that there are a lot of issues to be concerned about. It's not being reflected in the market yet, you say. And also some suggesting that, the bull story long-term remains intact. Are they wrong? Because they're suggesting perhaps you should be buying the dip right now.
Yeah, well, the dip buyers, they've got one thing going for them. It's always worked, and it's worked very, very well, and it worked again today. What I do think is happening, though, in the market, especially in the U.S. market, is there's been a market shift towards retail trading. Something close, probably the most retail-oriented market in the world might be India right now. But the U.S. is starting to see that happen, too. So if you really want to know who's the big power player in the U.S. market, it's not a hedge fund or a big institutional investor with a lot of assets under management. It's millions of retail traders, probably on some kind of social media platform like Reddit, getting talking and coming to conclusions together. And that's why dip buying, and that's why you've seen the meme stocks come, and that the powerful move we've seen in the Mag 7 and other related AI stocks. So there has been a shift. This is not the same market that we saw, say, pre-COVID.
Are you then suggesting, Jim, that perhaps it's the retail investors who will bear the brunt of a possible correction?
Well, whoever is the dominant player will bear the brunt of the correction. But I will say this as far as the retail investors go. They are raking in the profits. They are the ones that bought the market in a big way in April and May when the professional investor was selling. They are the ones that have been buying the market for the last 2 months while the professional investor has been talking about overvaluation. Now, the professional investor is correct. And maybe in the long run, that the professional investor might be proven correct and borne out. But throughout 2025, it has been the retail investor that has been the profit-driven investor, the one who's been making the most money. And that's why we've seen such an explosion in their activity in, say, the last 18 months or so.
If or when that correction comes, how deep will it be? We have Morgan Stanley saying 10%, Evercore saying 15%. Might it be deeper than that?
If it was to be deeper than that, you would have to have another catalyst with it. See, the way I look at it, like a lot of professional market commentators, a market can always correct 10%. The question is, can it go more than that? Well, it would need something like higher interest rates, a market slowdown in the economy where there's unmistakable thought of recession, maybe inflation driving those higher interest rates, or something like that. If I had to put, some probabilities on it, I'd say the highest of those is that we could see long-term interest rates move up. And that could really bother the stock market if we were to see a correction that could go more than 10%. Now, maybe the Fed is going to cut rates, but we saw this last year. The Fed cut rates last year. The market didn't like it, and we saw long-term interest rates go up right after the Fed cut. If we could see something similar to that again, and if long-term interest rates go up, I could see a 10% correction becoming something more.
Jim, I'm curious, some suggesting that perhaps it's the bond market that's standing between us and a financial collapse. Is that too melodramatic? Or is there any truth whatsoever?
Well, it depends on how you define it, but in some respects, it is the bond market that will, be the ultimate arbitrator of what's happening. In the U.S., we have giant budget deficits of around 7% to GDP. We've got a government budget overall that is about 24% of GDP. If you look at the 200-year history of the U.S., the only time it's ever been this large has been crises like COVID and World War II. Yet this is now kind of the average run rate in a peacetime, non-crisis environment. So this is unprecedented what we're seeing. And a lot of people like me think that this is unsustainable. Well, we're not going to find any kind of politicians to elect to Washington that are going to fix this budget problem. So the only place it's going to get fixed is the bond market is going to reject all of this borrowing. And it's going to say, if you want to borrow to keep it 24, 25% of GDP at the budget and 7% deficits to GDP, interest rates are going to skyrocket. And you're going to have to pay a heavy price in order to do it. and then that will force some kind of a reform on Washington in order to bring the budget deficit and spending under control. So the bond market is the only place that can do that. Now that I've said that, when does that happen? Does it happen later this year? Does it happen in 10 years or somewhere in between? That's the open question. But what I am trying to argue here is I know how we're going to fix this. It's going to be the bond market through punishingly high interest rates. But we don't have that just yet. But that's really the only mechanism we have to rein in the profligate spending that we've seen in Washington.
Like you said, there are structural issues. We've heard time and time again from Trump that he wants lower rates. It is not just about removing Powell from his position, yeah?
Yeah, well, I think it is about, it is about lower rates. And he wants to remove Powell because he sees him as an impediment to lower rates. But I do think there's a fundamental flaw in the argument that he's making. Well, there's two flaws. The one is he argues that we are the best country in the world. Everybody wants to be in the United States. He calls it the hottest country in the world. And let's assume all of that is true, and it could very well be true. What he's trying to argue is the U.S. should have low interest rates because it's a good credit. But that's not how you price sovereign bond yields. That's how you price the mortgage on Trump Tower in Manhattan, is that if it's full and everybody desires to be in it, its mortgage rate should be lower than everybody else's. Sovereign yields are priced on inflation expectations, budget deficits, growth of the economy. And given all that, we should be around 5% yields. And that's the one argument that I think he's been giving. The other argument is a fiscal dominance argument. And what that means is he's saying cut interest rates, lower interest expenses in the U.S. Well, the problem with that is cut interest rates, lower interest expenses. Then what do you do when you have inflation? You never raise interest rates because that would raise interest expenses. Every time you get a fiscal dominance situation that you're setting interest rates based on the amount of borrowing you've done, it always ends badly. And that's another warning sign or worry that he's making that kind of argument again.
The focus is on 10 years. Of course, that impacts mortgages, corporate bonds, so on and so forth. And some say perhaps 4.5% is a new normal. If anything, it is higher than 4.5%, but not below.
Yeah, I think so. I think that one of the things is people have been anchored to that period between 2010 and 2019. Zero interest rates, negative in Europe, negative interest rates in Japan. The only time in financial history we've ever seen negative interest rates was 2010 to 2019, and 2% or so on long-term yields. That was an aberration. And so many people I hear, especially in the U.S. here, talk to me about yield curve control, money printing, return to zero interest rates. I think that era is over. And what we have to understand is 4%, 4.5% yields on 10 years is normal. This is where they should be. This should not be an impediment to business or to government borrowing or anything like that. But the problem is too many people in the U.S., starting with the president, think that this is an abnormal thing that is holding back the economy. It's not. These rates are not holding back the economy. They're where they should be. And I think this is a difficult thing for people to come around because they're still anchored to that thinking that we had pre-COVID when we saw zero interest rates.
So how do you position, Jim? What do you buy? I mean, we spoke to an investor just yesterday, Mark Mobius. He's still hanging on to 50% cash from 95% before.
I've been making the argument, bigger picture, that over the next several years, the U.S. markets will be what I've referred to as the 4, 5, 6 markets. That cash will return you about 4%, which is what it's done over the last year. Bonds will return you about 5%, which is what it's done roughly over the last year or so. And stocks will return you around 6%, not 20 to 25 like it's done over the last couple of years, mainly because of that professional investor argument about valuations. 4, 5, 6 is not bad. Especially if we're at what I'm also arguing is a 3% inflation world, which is a little bit elevated. Those are not bad investments. The problem is with the U.S. is people act like you've shot their mother when you tell them that 4, 5, 6, because they think all markets should be going up 20 or 30% a year, and they need to, rein in those type of expectations. So given that, I think a balanced portfolio, some cash, some bonds, some stocks, will do very well. Because remember that cash has no volatility. It has the same price every day.
Right.
And if a money market fund or a treasury bill can return you 4%, you'll get more than half the stock market's gains with no volatility. Bonds will give you most of the stock market's gains with a lot less volatility.
Right.
And then stocks will give you a little bit more. So 4, 5, 6 is where I think you'd want to start to think about the markets over the next several years.
Given the noise, 6 ain't too shabby. Jim, thank you. Jim Bianco, founder and president at Bianco Research. Still to come on the show, we'll hear from a top White House official on U.S. efforts to prevent AI chip smuggling and President Trump's plans to safeguard American technology dominance. Keep it here with us. This is Bloomberg. Welcome back to Insight. The White House is working to add tracking tools to advanced chips, aiming to curb smuggling to China and protect U.S. tech leadership. White House Office of Science and Technology Policy Director Michael Kratsios told us more about how Washington's policies differ from Beijing's.
I think right now there's already a set of export controls around our highest end chips, and I think that's the current status quo. I think most of the discussion between China and the U.S. At this particular ministerial was more around AI governance. And the Chinese at a conference in Shanghai last week unveiled their action plan, and it focused a lot on global AI governance. And that's something that the U.S. takes a different position on. We believe that each country should be able to set their own destiny on the way that they think about regulating artificial intelligence. And we believe that the U.S. model, one that puts innovation first, is going to be the most attractive model for most countries around the world. So those are the types of conversations that were mostly discussed in the ministerial yesterday.
As much as the U.S. takes issue with China, China's taking issue as well. In fact, it says that NVIDIA chips are a security vulnerability for the country. What's your take? What's your response to that?
I think for us right now, the 3 highest-end NVIDIA chips are currently export-controlled, and the H20 chip that made a lot of news is one that any buyer in China will have to file for a license to buy it with our Commerce Department. So the Commerce Department will continue to go through the analysis of weighing the cost benefits of that particular sale. So in some ways, it's a marked difference from the way that the Biden administration thought about those chips, which essentially allowed them to flow freely into China.
Has there been any concern or evidence about smuggling of NVIDIA chips into China? Has that come up in some of these bilateral, multilateral conversations?
That's not something that's come up in this meeting. Obviously, there's been wide-ranging reporting on that particular issue, and there's been an effort by our Commerce Department to step up enforcement, and it's something that we need to continue to do more of. Smuggling is illegal, and we need to make sure that any country around the world that has an export license for a particular chip adheres to that license, and those chips don't end up in places they shouldn't.
So in the same breath, would the U.S. then support location tracking technology to ensure that smuggling doesn't happen?
That's a really great question. In the President's AI Action Plan, under the 3rd pillar, there is discussion around very important research and development that needs to be done on potentially the types of software or even physical changes you could make to the chips themselves to do better location tracking. And that's something that we're exploring and we explicitly included in the plan.
White House Policy Director Michael Kratsios there. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're counting down to the kickoff for the Indian rupee. Of course, traders in India mulling what Trump said overnight and that he may raise those tariffs for India. Those 25% tariffs are already quite crippling. The prospect of higher tariffs may just impact its economy further. In terms of the Indian currency, 87.66 is what we're looking at right now. It is down 0.1%. Of course, the Indian rupee has been trading against a weakening US dollar. In terms of Nifty futures, pointing to a slightly higher open, up about 0.1%. Indian stocks, of course, pretty expensive, among the most expensive in the region. Well, our next guest believes India will be able to shrug off the US tariff blues and is urging calm. Joining us exclusively, Rashesh Shah, chairman of Edelweiss Group, one of India's leading diversified financial services organizations. He has served as president of the Federation of Indian Chambers of Commerce and Industry and on the executive committee of the National Stock Exchange. Rashesh, good to have you with us. You liken the tariffs to a cold rather than a cancer. You say it is not time to panic. Why is that?
Thank you. Thank you for having me. Yeah, I think it is an issue for India, but, we are a $4 trillion economy. Exports are not a very important part of our economy. The local savings, the local consumption, our own investment needs that are there is going to drive our economy. So on the margin, exports, especially exports to US, will matter. But a large part of our exports to US are also not in goods. They are in services, which may not be affected by this recent 25% tariff. So I think overall, it will be an issue. It is an additional weight to carry. That's why I call it a cold. And a cough is going to be, is going to be a little bit of a problem. But the economy is strong. I think as we have seen the markets, the local household savings have been very robust in the last 5-10 years. So that will keep on driving the Indian economy stronger. On the US side, I do feel that this entire tariff issue is part of a larger problem, which is a geopolitical alignment. And I do hope that we resolve it. I'm pretty confident. I think a lot of this is threatening and posturing and all, but I do feel India and US will arrive at some equation to go forward.
Rashesh, yes, India is a $4 trillion economy, but the U.S. is India's largest trading partner. And if nothing is done to bring down those tariffs, then, exports to the U.S. could drop, 30%? I'm giving you a figure from, $86 billion down to $60 billion. That is substantial.
Yeah, but, as I said, they are part of the exports are software and pharma and all, which may not be affected. So I think overall, the impact on tariff will be about $8-10 billion. There are quite a few calculations that have happened, which will pinch on the margins. A lot of corporate, especially goods manufacturers like textiles and gems and jewelry, which are very dependent on US markets, those sectors will definitely get affected. So I think individual companies, individual sectors will definitely have a fairly big impact, as you said. But for the economy as a whole, for the Indian economy as a whole, this will be not as crippling as it appears when we look at news headlines. As I said, it is an issue, but it is not an issue on which we need to panic and try to do something in a hurry. And I'm pretty optimistic because the Indian government has been fairly measured, fairly quiet. So we are not burning our bridges. Right. We are not taking hard stands. So I think something will improve from where we are now.
So no risk whatsoever, if you're right, that the Indian equity market will be impacted?
Not because of this issue. I think the Indian equity markets has recently been soft. As you very correctly said, it's been, fairly expensively valued because there's a lot of local money that has been going in the equity market. We expect about $70 to $80 billion a year of Indian money flowing into the equity markets. And we have had a spate of IPOs. But still, the demand for equities locally is much stronger than the available supply of new paper. So on that count, equity market should be stable. We are facing some headwinds in terms of growth. As you know, last 2-3 quarters growth has slowed down. Fortunately, the Reserve Bank of India has been easing off interest rates, has actually pumped in a lot of liquidity. So because of that, we do expect it will still take a couple of quarters for that liquidity to get translated into growth and all. So currently animal spirits are low. Growth has been slowing down, but all these are India factors. I think the US exports will only add to a little bit more weight on that. But the larger challenge we need to overcome is a slowing Indian growth and the slowing corporate earnings that have been going on for last 3-4 quarters.
Speaking of the RBI, are you expecting further easing from the RBI, and that could, provide the catalyst for a rebound in Indian stocks?
I think RBI is going to announce their policy tomorrow. I don't expect them to cut because the last cut was a very hefty one. They cut about 50 basis points. I think they're going to keep some ammo out there. The rupee has also been weakening, so cutting now will put additional pressure on the rupee. So I expect RBI in this meeting to hold on to the rates, but I think the commentary will be a lot more accommodative. The commentary will be a lot more positive on growth. And RBI truly has been saying that they want to do everything to promote growth. But the liquidity they have pumped in, as well as the interest rate they've cut, they have not got translated. The banks have not passed on the full rate cut benefit to the borrowers yet. It will still take a couple of quarters, and when the animal spirits come back, we will see a credit growth pick up. I don't expect that to happen before December or so. So I think the next couple of quarters will still have this slowdown, which will continue, but the RBI actions will hopefully result in growth coming back 3-4 quarters down the line.
Any target for the Sensex by year end?
Very hard to say. I think from where we are, if we are flat, it should be okay, because I think corporate earnings are going to be slowing down this year. I think the first quarter has been pretty slow. I think the next couple of quarters for sure, corporate earnings will not be growing very fast. So the slowing corporate earnings, we have 8-9% corporate earnings growth rate. It does not augur well for a strong upside in the equity markets. And last 3-4 years, we have had very strong markets. The markets are fully valued. I think we need the growth and earnings to catch up with the optimism that is already built in the valuation.
You're looking at animal spirits returning, but perhaps not this year. How do you position for that? Where do you see the biggest opportunities? Some have suggested perhaps it's in the consumer plays, as Prime Minister Modi talks about, encouraging Indians to buy made in India.
I think consumer play should come back as the RBI liquidity filters down to the middle class spending. But along with that, I think banks have been looking pretty good. I think, as I said, the credit growth will come back. The banking industry will pick up. So I think banking, I also think IT services have been hammered down a lot. I mean, they have had a slowdown and they're facing AI-based challenges. But a lot of analysts do believe that IT sector will continue to grow between 12 to 14% a year. And the current valuations actually are very, very attractive. So I do think there might be a little bit of upside there also. So there are individual pockets, individual companies. But as I said, I don't think the idea is to expect a big surge in the market. The idea is to do very quiet stock picking. And I think a flattish equity market for the next 3 quarters might not be that bad for a good long-term investor or for a good stock picker.
In my conversation with Jim Bianco just earlier, he talked about how retail investors have propped up the markets in a big way. The U.S., case in point, India in particular has seen a resurgence, a strong appetite from retail investors. Do you expect that to continue? Might we see a slowdown and, in the process, impacting valuations?
Actually, retail flows in India have been very strong. The mutual funds are now getting about $35 to $40 billion of retail flows in their equity funds, which is a fairly big sum. This used to be about 8-10 billion about 8-10 years ago. So we have gone from $10 billion to $40 billion a year coming into mutual funds every year in equity markets. So I think the retail flows are strong as long as interest rates are low, because the bank deposits are not very attractively priced for a retail investor. And even if the equity market gives about 11-12% return compared to a 5% return in the bank deposit, flows in the equity market are still attractive. So I do think equity flows will continue. We will expect about, as I said, local savings about 70 to 80 billion from the mutual funds, through insurance companies, through the pension funds coming into the markets. So I think that flow will keep the market stable. As I said, the flows will keep a floor on the market, while the current valuation and the slowing down growth earnings growth will keep a cap on the market. So we should see a range-bound approach. I think investors should expect not a big surge. They should expect a range-bound market, and hopefully the next 2-3 quarters, all these global issues will go away, as well as Indian growth will start inching up.
You talk about India growing, and it seems like there is space for a lot more players. How are you positioning your business? Is there perhaps an appetite to get into the segments that you sold off to PAG, for instance?
I think, India has a huge amount of opportunity, and we are very focused on what we call the capital market-related businesses, which are asset management, wealth management. And our insurance business is also growing pretty well because a lot of this household savings also coming through insurance into investment products, both yield incomes kind of needs as well as growth needs for investors. So our current approach is, I think anybody in financial services in India should look at 2035. India is a $4 trillion country. We do think we should be a $10 trillion country by 2035. We have been doubling every 8 years. So we are 4 now, maybe by 2032, India should be 8 trillion and should become a $10 trillion country. So anybody who wants to really position themselves for the India growth should look at the next 10 years and say, when India goes from 4 to 10, what is going to happen to household savings? What is going to happen to financialization of markets? What is going to happen to the investor needs in growth, income, yield? And a lot of innovation is required. India, obviously, you also have to manage cost very well because it's still not a very high per capita market. So unit economics matters a lot. So I think working on all that, using technology, AI, all of that, for the next 10 years, I think financial services, especially investment-related financial services via capital markets and insurance, are very big opportunities.
And also in the area of private credit, right? Because there's been a lot of interest. You have a fund in private credit. How are you assessing the competition that you're seeing right now?
Yeah, we are seeing a huge amount of opportunity from the local money because, as I said, Indian investors had only 2 options. If you wanted income, you got a 5% in the bank deposit. And if you wanted growth, you had to come to equity markets. You didn't have something in between which gave you not the equity market kind of return, but without the equity market volatility. So I think private credit funds, which are giving 12 to 14% kind of returns in India, have been in huge demand. And I think a lot of the local money, a lot of the household money, HNIs and family offices are now understanding this yield and income opportunity. So I think from only growth-oriented allocations, a lot of the high net worth family offices, we are still not seeing institutional money from insurance companies and pension funds coming into alternative yield and income strategies. But we do think what has happened in the US will also happen in India. And we see a lot of demand for private credit yield income strategies in alternative space.
Rashesh, given your standing in the financial industry in India and your former roles at SEBI as well as NSE, I'm just wondering if you could comment on the compliance issues that Jane Street is experiencing right now. What's your take on that?
I think, there have been a lot of articles written. I think Bloomberg has done a fabulous job covering this, explaining all the nuances. In fact, recently there was a very good article in Bloomberg itself which said there is a thin line between arbitrage and manipulation. So I think it is in the new world. I think ultimately it will be a matter of what was the intention, what was the end result, who really benefited, and was it done in a very compliant manner. So I think it's an interesting case to watch. I think it will be a landmark case in Indian courts. Obviously, SEBI will do a lot of homework. They've been doing a lot of fact finding. Jane Street is a very large player. They also have a lot of resources. So I would actually wait for this to unfold in the courts, but it is going to also change a lot of the high frequency and arbitrage trading in India, especially as you know, options and futures and options have been a big market in India. There's a lot of new stuff out there. And I do expect that the rules on option trading will get much strengthened as this entire episode unfolds.
From where you're seated, greater scrutiny is justified.
Absolutely. I think, as you know, a lot of Indian retail investors participate in the option markets. Maybe, quite a few of them lose money as per the reports we are seeing. So I think more transparency, more clarity on rules of the game, more guardrails will be helpful. I'm all for that. I mean, I do believe that capital markets play an important role in India. But if we can have a lot more capital formation and long-term investing and a little bit less speculative trading, it will be helpful for the country.
What changes would you like to see?
I think the options trading, especially the shorter term options, have become very, very speculative, and they're not aiding either in capital formation or in the price discovery. So having strong margining requirement, having more qualification, having qualified investors participating in that, not having really too many short-term options, having medium-term options so that they can be used for hedging. Option market should be used for hedging and should be used for price discovery, but not for just speculative, intraday punting, because that ultimately does harm the retail investors. And in a country like India, which is not very evolved in terms of capital markets are relatively new in India, we need to keep those interests also in mind. And we have to be a little bit more proactive in building the guardrails and not allowing completely, caveat emptor, laissez-faire kind of affairs in the capital market. And I do expect, I think when I hear what a government and SEBI and all are saying, I do expect a lot more guardrails which will come about, which will not allow this rampant speculative trading to grow in a very unabated manner. I think it is an essential part of Indian capital market, but should be one part along with the long-term investing and the capital formation objectives.
So having said that, Jane Street is the first, but won't be the last. There'll be more to come, you think?
I don't think so. I think, as I said, there is a lot of retail investing that is going on. There is a lot of high volume that has been there. I don't think there has been really bad play that in a very rampant manner that there'll be more to come. I don't think there's so many bad things happen, but the rules of the game have not been very clear. What is arbitrage? What arbitrage is impacting price discovery, especially closing price, especially with intraday options. All these are very gray areas. The rules have to be strengthened. The rules have to be clarified, and guardrails need to be built. And I think it will come out of that. I think everybody will benefit into creating a stronger foundation out of this episode.
Great insights, Rashesh. Rashesh Shah, Chairman of Edelweiss Group, thank you so much for your time today. Still to come, our exclusive interview with the CEO of Japan's largest bank, MUFG. We'll get his views on when the BOJ should hike interest rates. Keep it here with us. This is Bloomberg. You're watching Insight. The CEO of Japan's biggest bank, Mitsubishi UFJ Financial Group, says it's desirable that the BOJ raises rates as soon as its next meeting in September, given Japan's higher inflation outlook. Hironori Kamezawa spoke with Bloomberg exclusively about interest rates and Japan's recent trade deal with President Trump.
I don't think everything is completely clear yet, but the fact that an agreement has been reached is significant. I believe this gives us a clearer outlook than before. An increase to a 15% tariff is not a small number, and many sectors and companies are likely to be affected. On the other hand, the fact that we can now see some clarity is important. When we set our performance targets at the beginning of the fiscal year, we did so based on the assumption of an increase of tariffs to 10% plus a buffer, the level at which the global network and supply chain would not be disrupted. In that sense, the 15% increase is slightly higher than our initial forecast, which was closer to 10%, but it's still within the range we expected. Overall, regarding the outlook for the Japanese economy, I think the underlying economic recovery will remain intact. GDP will probably decline by around 0.5 to 0.6%, but the underlying economic recovery will continue. As for our current plans at MUFG, we believe that there is no need to make any major changes at this point.
The Bank of Japan held its monetary policy meeting. The decision was to keep rates unchanged, but with tariff negotiations settling down, some are saying that the environment for a rate hike within the year is in place. What is your view on the possibility of a rate hike within the year?
Our official company view sees March next year as a possible timing of the rate hike. But personally, I think September or October is quite possible. I think that a rate hike in September or October could be desirable. The reason is that inflation is still quite strong. The number of items subject to price increases has grown by about 5 times compared with last year. And there's also the issue of imported inflation. In that sense, I personally think that this autumn is a reasonable time for an interest rate hike. But as various statistical data will be released in the coming months, if the growth rate figures are not as strong as expected when they come out, there may be discussions to take a wait-and-see approach. The timing could shift to around March next year. We'll see a period of careful monitoring of economic data, but I think it's entirely possible.
And that was Hironori Kamezawa, CEO of Mitsubishi UFJ Financial Group, speaking exclusively with Bloomberg's Hideki Suzuki. Speaking of Japan, let's do a check on how Japanese assets are doing. We know the equity markets have been extending gains. We have the topics hovering near record highs, currently extending that gain as well, up by about 0.9%. That's on the back of clearer BOJ messaging, steady corporate reforms, and of course, better than expected U.S. tariff deals. Over in Hong Kong, this is how it's looking. Hong Kong, by the way, having a black rain alert in force until at least 3 p.m. Notwithstanding that, we're seeing gains for the benchmarks in Hong Kong as well. We have the Hang Seng currently up by 0.3%. Hong Kong saying that the black rain alert to at least remain in force until 3 p.m. And before we go, here's a look at our show tomorrow. Join us for an exclusive interview with Tech Mahindra CEO and MD. We're talking about Mohit Joshi as India's IT sector struggles to catch up on the global AI rally. Of course, Indian markets are pretty expensive, among the most expensive in Asia. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.